So it's a great time we meet for this session of financial reporting and analysis. So for today, we are going to talk about the presentation of cash flow statements using the indirect method and direct method. So what does cash flow statements pertain? Why do we prepare cash flow statements? So the cash flow statement shows the sources and application of funds for an entity. So the sources of funds can be from three areas: operating activities, investing activities, and financing activities. So the sources of funds can be from operating activities, investing activities, and financing activities. When we talk about the aspect of operating activities, it includes the day-to-day operations. So the cash generated from day-to-day operations, the day-to-day operations. After taking into consideration the aspect of working capital, of which we always say that working capital is all about current assets minus current liabilities. So in short, the operating activities is the cash generated from day-to-day activities. So for investing activities, these are about the funds generated from the disposal of non-current assets. So what you generate from the disposal of the non-current assets. Then for the financing, remember that an organization can be financed through debt or equity. That is what you are told in financial management. So how would be the organization be financed? For example, through issue of shares, through borrowings. So that is what we will be talking about when I come to the financing activities. So the way the organization was financed through the borrowings or through the issue of shares. So that is just a short introduction. Then there's two methods of presenting cash flow statements. So the first method being indirect method, and the second method being direct method. So under indirect method, remember that you will present your cash flow statements in those three parts, based on the three activities. So that is operating activities, investing activities, and we'll talk about the financing. Even the direct, we have to do that. But now, what is the difference between the two? What is the difference between indirect and direct? Which part will be a bit different? So the part which will be different between the two methods is only the operating activities. It's only the operating activities. That one is the one which would be different between the two methods. So for the others, that is investing and financing activities, in both two methods, they always remain to be the same. So, International Accounting Standard 7, a presentation of cash flow statements. Presentation of cash flow statements. Presentation of the cash flow statements. So we have methods to be used, methods of presentation. So the methods of presentation, number one being the indirect method. Number one being the indirect method. Let's say, for example, we have XYZ Limited. Statement of cash flow. Statement of cash flow. Statement of cash flow. Statement of cash flow. That is for the year. So for the year ended, let's say a certain period there. So let's say we are talking about indirect method. So for the indirect method, we always start from operating activities. We always start from operating activities. So the operating activities. So once we start from the operating activities, we start from the profit before tax. We start from the profit before tax. We start from the profit before tax. So when we talk about the profit before tax, remember that profit before tax will be from which point? An income statement. An income statement would be from an income statement. That is the profit before tax. So an income statement, for you to get to the point of profit before tax, remember that we have to take sales less cost of sales, less the cost of sales. You get the gross profit. You add incomes, you less what? Expenses. You less the expenses. My concern will be most under incomes and expenses. So the incomes which are deducted, not the incomes which are deducted, the expenses which are deducted and the incomes which are added, they are both operating and non-operating. They are both operating incomes and the non-operating. So you might come across the two. So in adjusting this, now the profit before tax, because the next thing is all about, we talk about adjustments for. In adjusting the profit before tax, there's those expenses or incomes which were considered in order to arrive at the profit before tax, which are non-operating. The one which are non-operating. The one which would be both in the income statement and the additional information which would be given, because the items which would be in the income, in the additional information, they have not been adjusted anywhere. So meaning the non-operating items, that is incomes and expenses, which were adjusted to get the profit before tax. If it's incomes which were added, we raise, because now I will be adjusting this profit before tax. So if we have non-operating incomes which were added, we add back, we raise non-operating incomes. The expenses which were deducted and are non-operating, we do what? We add them. The expenses, we add them. So, and these are the expenses I'm talking about and incomes. They are just standard, so you don't have to struggle. So you talk about depreciation. So depreciation is an expense. So this one was deducted. You add back. You talk about impairment. Talk about impairment loss. This is an expense. This is when a goodwill loses value. When a goodwill loses value, we always say that it has been impaired. So this is an expense when goodwill loses value. So this one we add back. If there was amortization is loss in value of other intangible assets. This is again an expense, we add back. The loss on disposal. If we disposed some assets, we lost what we were supposed to generate. The loss we generated, that is an expense, we add back. The gain on disposal, this is an income. It was added, we subtract. Then after that, you consider the finance cost. This is an expense. It was subtracted, we add. We consider the share of profit after tax in associates. Share of profit after tax in associates or joint venture. So this one was an income. We subtract. But now this one, nowadays, in the questions of cash flow, you can't find that you are given associates or a joint venture, because after they changed the syllabus, what they did to the cash flow statements, they said cash flow statements to be part of published. So you will not find these. It's only that I'm mentioning them due to the illustration I will do. You will come across there too. But now, once I will be moving to, in our next session, that is tomorrow, I will be doing the receipt in question. This one will not be available. So it is just 2 items which will not be there. But due to the illustration I will do, I have to include them. But this is the standard way you are supposed to do the cash flow. So there's no another confusion or what. So other than the one I've recorded there, let me add one item here called investment income. So anyway, this one was added, we subtract. So up to this point, what we have here is all about the cash flow before working capital changes. Before changes in working capital, before changes in working capital. So shillings there. So cash flow before changes in working capital. So that is the, after you have adjusted your items against the profit before tax. Then changes in working capital. Changes in working capital. So the working capital is all about current assets minus what? Current assets minus current liabilities. So you talk about increase in current assets, the increase in current assets, the decrease in current assets, the increase in current liabilities, and we have the decrease in current liabilities. So increase in current assets. Now, from this point of changes in working capital, changes in the working capital, from that point, here now we are checking movement of cash in and out of the organization. So, like now, when your asset increases, what happens to your cash? You have bought assets, it means that there's money out. When your asset decreases, it means that you have disposed your assets, you have received money. So that is cash in. When liabilities have increased, it means that you have acquired more liabilities. So you have received money, or you have sold, you have made a sale. So in current liabilities, let me use this example. Let's say, for example, I will be talking about creditors balances. Creditors balances. So who are the creditors? The people who sells to you on credit. The individuals who sells to you on credit. So if they have sold it to you on credit, is there any money you have paid out? There's no money out. You have just received the goods, but there's no money you have paid. Then when your current liability decreases, now when you pay the creditors, there's money out. There's money out. So up to that point, we have the cash generated from operations. We have the cash generated from operations. Cash generated from operations. So that is it. Then now you raise tax. Tax paid, you deduct. So after deducting the cash paid, you get cash flow from operating activities. Cash flow from operating activities. The cash flow from operating activities. So the cash flow from operating activity. So that is what you put on the far end. And this one is your A. Then Now you move to investing activity. So it means that for the operating, we are done with it. So it's all about starting from the profit before tax. Then you adjust that profit again as the incomes and expenses, which are non-operating. You get a cash flow before changes in working capital. Then changes in working capital, you check the increase or decrease in current assets or current liabilities. So remember that for the current assets, it's all about inventory and receivables. You mostly focus on inventory and receivables, and on some cases, prepayment. For the current liabilities, it's all about the payables, and on some cases, accruals, but not accruals for interest, because accruals for interest goes to the financing activities. So that you get the cash generated from operations, you less the tax paid. For tax, you have to check for both deferred tax and the current tax. Then for investing now, I said you focus on the cash generated from the disposal of what? Assets. So cash received from what? Disposal of assets. Cash received from the disposal of assets. So this is money in. Cash paid to acquire assets. So in some cases, you can acquire assets, you pay cash, that is money out. Then you consider dividend received. So the dividend received, that is money in. You consider investment income. Again, you earned. So those are the 4 items to consider here. The cash you receive, you always receive from the disposal of assets, what you pay from acquisition of assets, dividend received, and investment income. So up to that point, we are done with investing. So you say cash flow from investing activities. Cash flow from investing activities. So the cash flow from investing activities. So that is your B. Then for C, it's all about financing. So for the financing, I said we consider what? How the organization is financed. The organization can be financed through debt or equity. So financing activities. So it's a continuation. I think you understand that. This is a continued statement. So financing activities. So for the financing activities, mostly we focus the items under equity and liabilities. That is where we focus most. So because now you can receive cash received from where? From issue of shares. So the cash received from issue of shares. So you can pay cash, cash paid on redemption. Cash paid on redemption of shares. So you can pay cash on redeeming shares. So cash paid on redemption of shares. So we can talk about dividends paid. So dividends can be paid by a parent, and the dividends can be paid to NCI. Dividend paid to NCI. NCI is minority shareholders, non-controlling interest. So this one, you do what? You deduct money out because it's paid. Then after that, you can talk about obligations, like now, acquisition of loan. So this is money in. You went and took a loan from a financial institution. So loan repayment, you can pay the loan. So money out. Then we can talk about interest paid. So interest paid, that is money out. Interest paid, that is money out. I think we have considered everything which is required. So up to that point, we can say now cash flow from where? From financing activities. So that is what you put at the end there as your C. So remember that A was this one from operating. B was the one from investing. Then now C is the one for financing. So you're now to get the net cash flow. You say A plus B plus C. A plus B plus C. Then you do what? You add cash and cash equivalent. Balance brought down. So that you get the cash and cash equivalent. Cash and cash equivalent. Balance carried down at the end there. So that is how you present your cash flow statements using the indirect method. So I want to mention something about what we have done. So right now, when talking about the cash and cash equivalent items, they include these items. So cash and the cash equivalent, cash and cash equivalent components include. Here we'll talk about cash in hand, cash at bank. We talk about cash at bank. We talk about bank overdraft. Before we talk about bank overdraft, we can talk about short-term investment. We can talk about short-term investments, i.e., financial assets. Financial assets at fair value. Then we talk about bank overdraft. So those are the items I would consider for the cash and cash equivalent. So for the others, remember that are from the workings we will do from the question. So that's all about the indirect method. That is all about the indirect method. So I said for the direct method, right now we are doing direct. I don't want to write a lot of headings here and there. You know that there is always an heading in every statement you present. So the only part which will be a bit different from what we have presented is only that operating activities. How will the operating activities look like when presenting using direct method? So the operating activities. So this is how you will arrive at the operating activities. So we will talk about cash received from customers. Cash received from customers. You talk about cash paid to employees. Or we can mention first suppliers. Cash paid to suppliers. Then we talk about cash paid to employees. So we have seen cash received from customers, cash paid to suppliers, cash paid to employees. So up to that point, you get what? Cash generated from operations. Cash generated from operations. So you get cash generated from operations. Then after that, you raise what? You raise the tax paid. So after deducting the tax paid, you get the cash from operating activities. So that is how you do it. But now you cannot be given cash received from customers direct. So which account do we maintain for you, the customers, when we sell to the customers goods on credit? To be more specific, which account do you maintain? Yes, so I can see that is good. Yom and the others, you are saying that trade receivables. So meaning that for you to get your cash received from customers, you always do your first working of preparing trade receivables account. Trade receivables account. So this one, the balance brought down starts with a debit. The balance brought down. You debit here, balance carry down, you credit. Then what increases this account? What can increase this account? Sales on credit. The sales on credit. So the sales you would be given in an income statement, which will be provided. You always assume it's on credit. Even if they say just sales without mentioning on credit, we would assume that it was on credit. So it can be sales or revenue they will provide in the income statement. So meaning that revenue was generated from a credit sales, or will be generated from the sales we made on credit. So what else can reduce this account? So here we have discount allowed. If you give a discount to your customers, bad debt written off. If you write off some debts, yes. So that is the case. So if you write off some debts and if you allow discounts, so that the balancing figure here is now the cash received. So your balancing figure is that cash received, the one we were looking for. So this one would be the cash received. Then for the cash paid to suppliers, working two, you will have to do what? The first thing you do is to determine credit purchases, because your suppliers are the one who will always sell to you on credit. So you have to determine what? The credit purchases. So how will I determine the credit purchases? I will say cost of sales is equals to what? Opening stock plus purchases minus closing stock minus the closing stock. So how will I get the purchases? So I will make it the subject of the formula. So purchases is equals to, so it will remain on that side, so that I say cost of sales minus opening stock, because now this one will come on this side. It will close the equal sign. So opening stock plus the closing stock. So this one closing the equal sign, it will be a plus. So that is what you have as your purchases. That is credit purchases. That is how you arrive at credit purchases. So after getting the credit purchases, then you prepare trade payables account, not the receivables, your suppliers. So you prepare trade payables account. You prepare trade payables account. So for the trade payables account, remember the balance brought down on the credit side. Balance carried down here. So what can increase this account for the payables? What can increase your creditors balances? So these products you have purchased on credit. So credit purchases. That is why I first said we have to determine credit purchases. So it has increased the credit balances. What can reduce your creditors balances? If the supplier gave you a discount. So discount what? Received. If you received a discount. So that the balancing figure now is what you paid the supplier. The balancing figure is what you paid the supplier. So we are going to do that question, November 2018, question 3B, presentation of cash flow statements. So they were saying that the following financial statements relate to Sasmua Limited and 18 investment companies. And 18 investment companies for the year ended 30th September 2018. So consolidated statement of comprehensive income for the year ended 30th September 2018. Then statement of financial position. Remember that you will be given statement of financial position for 2 consecutive years, meaning that the balances for the previous year will be the opening for the current year. Then this income statement is for the current year, 2018. Then you can see under the statement of financial position, you are given that of 2018, 2017. So meaning that the balances for 2017 are the opening for 2018. Then we have a statement of changes in equity. Then we have additional information. The property, plant, and equipment account comprised the following. We have the cost and we have the accumulated depreciation. During the year ended 30th September 2018, an 80% owned subsidiary revalued its property upwards by 150 million. The holding company disposed of an item of plant which had cost 290 and accumulated depreciation of 96. The disposal proceeds amounted to shillings 215 million. Number 2, the 10% convertible loan stock was convertible at any time at the holder's option into 20 ordinary shares of shillings 10 each for every 200 of the loan stock. During the year ended 30th September 2018, holders of 180 million of the 10% convertible loan stock exercised their conversion option. Impairment loss, that is number 3, impairment loss on goodwill and the depreciation for the year ended 30th September 2018 have been charged to the profit or loss, assume corporation tax rate of 30%. So consolidated statement of cash flow for the year ended 30th September 2018 using indirect method in conformity with the requirement of I-7 statement of cash flow. And this is a question of May 2018. So that is May 2018, question 3. So May 2018, question 3. So it's question 3B. So since the examiner was not open, which method to use? When the examiner is not obvious, open, go for indirect method. Because this one will not waste a lot of time, and this one will give you a lot of marks under the operating activities before even you move to investing. And it seems to be more easier. Even if, yes, I will do other illustrations using direct, you will come to understand how they apply. That is both of them. So for now, we'll be using indirect method. So we can write the heading anyway to make it a bit official. So we say Sasmua. So the question, the company that is this question, the company was called Sasmua Limited. So they need a consolidated. So anyway, let's say statement of cash flow. Statement of cash flows. So statement of cash flows. So that is for the year. So our current year was ending 30th September 2018. So remember that for the income statement, provided there, you are given the one as of 30th September 2018. For the statement of financial position, you have that of the year ending 31st September 2018, which starts on 1st November 2017. And you have that one of the year ending 31st September 2017. Meaning that these items for the previous year, the statements of the previous year, remember that they are opening here in the current year, because once you move from 31st September, you move to 30th October. So, and that one means, so Ayom, you are saying? So it's not a question, maybe you're answering someone else, it's okay. But if you have a question, you can.
I think he's trying to say that it's 30th September, not that fast.
Oh, sorry for that. I know for the people who prepare statements now and then, those 30th and 31st. There's not 31st. We're coming with our own date. So it's 30th September. And we have 30th September 2017. So for 30th September 2017, that is the balances from 30th September 2017 are the one for 1st October 2017. So when I will be mentioning something called balance brought down, you understand? I mean the one which are opening this year, they are from the previous year. So here they are carried down, but here they are brought down. So this one is the carried down here. If there was a next year, you have a carried down. So we start from operating activities. We start from operating activities. So when we mention about operating activities, we mention profit before what? Profit before tax. So checking in my question here, the question which I'm using, so they are the copy one. So the profit before tax is which figure? 395. So that is the profit before tax. Then we say that we adjust this profit. Adjustments for. We adjust for what? So you mentioned depreciation without even checking if they are present or not. Impairment. Amortization. You just write them before even you check if they are present. Loss on disposal. And the gain on disposal. These are the first items you just write. You just write them before even checking if they are in the question. Then non-operating items. The non-cash flow items. Then now we can go to the question and check if they are present. Was there depreciation in this question? Depreciation for the year. Was there impairment? Was there amortization? Loss on disposal, gain on disposal. So in the additional information, what is provided there? Is the depreciation given? In this question of ours, depreciation was not given direct, but you were given information to assist you in the determination of that depreciation. In the determination of that depreciation. So let us display that question for your understanding. So if you check note 1, you are told property, plant, and equipment account comprised the following. So we have the cost and accumulated depreciation, and we have the carrying amount. Accumulated depreciation is for years where the asset has been in existence. For the assets, for the period they have been in existence. The non-current assets, you understand? Property, plant, and equipment is just non-current assets which have been aggregated. So you have accumulated depreciation, meaning that we have to do a depreciation account for us to determine what? Depreciation for the year. So when preparing the depreciation account, it goes hand in hand with the disposal account and the PP account. So those 3 accounts, they go hand in hand. I think you have seen that from additional information number 1. So that is the information I would be using. So meaning that for me to do the depreciation account here, of which I can decide to do the disposal account, then for the PP account, I will do it. I can decide again to do it at this point. So they go hand in hand. So these 3. So for the disposal account, it's a standard account, whereby you have your cost of the asset which they disposed, you have the accumulated depreciation, and you have the sales proceeds. This is very standard. So there's information provided that there is something which was disposed there. The sentence in note 1 down there. During the year ended at 30th September 2018, an 80% owned subsidiary revalued its property upwards by 150. The holding company disposed of an item of plant which had cost to 90 and had accumulated depreciation of 96. The disposal proceeds amounted to 215. The disposal proceeds amounted to 215. So the cost of the asset which was disposed is, from that question, the cost is, at least contribute something I can, so that I know you are there. See, nikuwe najifunza hapa. Wamesema cost ni ngapi?
290.
Yeah? 290,
290.
Yes. Accumulated depreciation is 96. Then the sales proceeds, the disposal proceeds amounted to 215. So do we have a gain or a loss? So if it's a gain, it's supposed to be on this side. If it's a loss, it's supposed to be on this side. So the balancing figure from this account, it's just a matter of taking your calculator. You add.
21. 21.
That
It's
is
again.
it's a gain of
21.
21. So already we have this. Already we have that. So again, it was added initially. If we were to record it in the income statement, it was supposed to be added. So yeah, it means that we subtract. So the depreciation account, the balance brought down is, because for the asset, the balance brought down will be on this side, and the balance carried down will be on this side. So meaning that for the depreciation, since it's a deduction from the PPE, The balance brought down will be here. The balance carried down will be on this side. So the balance brought down for the accumulated depreciation, that is for the accumulated depreciation ni ngapi wanafunzi? The balance brought down is 625. So I said when I mentioned something concerning 2017, you would know that I mean what? Balance. I interpreted those dates. Those balances from 2017 would be my balances carried down. Then for the one as at the end of 2018 would be balances carried down. So meaning that the balances carried down here is, according to the question, is 934. That is 934. So there's various things here now to consider. Remember, under disposal account, there was an asset which was disposed. Sindio? There was an asset which was done what? Disposed. So this asset which was disposed, it was having an accumulated depreciation of 96. So this one has been credited. So what will I do to the depreciation account? Will I credit or I will debit?
Debit.
I will debit.
Yes.
I will debit this. So this is 96. So I will mention here disposal account. The disposal. So the balancing figure for this account is the figure. That is what just I'm asking.
405.
So 405. Which side?
Credits.
The credit side.
So that is depreciation for the year. 405. So that is what I was looking for here. So that one you add. That one you add. So for impairment, you have to check for goodwill. So from the non-current assets, so there's a decrease from 455 to 455 to 432. So that is the impairment. So the difference is Faisal, you have said 23. And that one you add back. So for amortization, what is amortized? Other intangible assets other than goodwill. So there's no other intangible assets under those non-current assets. What I can see in my non-current assets, according to my question, is property, plant, and equipment, interest on joint venture, goodwill on acquisition. I don't have any other intangible assets like patents, trademarks, software. They are not present, meaning that amortization is not there. Amortization is the loss in value of other intangible assets other than goodwill, which is impaired. There is no loss on disposal because there is nothing else we disposed other than what we have checked. Then, after you have recorded now the 5 items, the first 5, you go back to your income statement. Go back to your income statement under profit before tax. So let me display that. The income statement. So I have said other than revenue, cost of sales, selling and distribution, and admin expenses. Other than those 4 items, anything else which is above the profit before tax is non-operating. That is other incomes, finance costs, and the share of profit of joint venture. Those are non-operating. We need to adjust them against the profit before tax. Meaning that like now other incomes, it was added, I subtract. Finance cost was subtracted, I earned. Share of profit of the joint venture was added. I do what? I subtract. So let's record those items which are above the profit before tax, which are non-operating. So I've said other than sales, which is revenue, cost of sales, selling and distribution, and administrative expenses. So we talk about other incomes. So other incomes, that is, it was 21. So that one was added, we subtract. It was added to the profit before, to get the profit before tax. The next item is finance cost. The next item is finance cost. So what about the finance cost? It was subtracted, the 85. We add, then we have the share of profit, the share of profit of joint venture. So the share of profit of joint venture, it was added, we subtract. So we have here the cash flow before changes in working capital. So I will write in that way, changes in working capital. So cash flow before changes in working capital. So give me the figure. Give me the summation there. All right. So here we have 781. So let us finish the working of PPE. So the balance brought down is 29, 70. The balance carried down was 37, 65. So in that additional information, the additional information number 1 down there, they said during the year ended 30 September 2018, an 80% owned subsidiary revalued its property upwards by 150. So revaluation will affect the asset. So which means that we'll debit the asset account, we credit the revaluation reserve account. So meaning, so the revaluation is 150. Then looking at the account which we have here, like now the disposal account, there was this asset which was disposed. It was having a cost of 290. That one will reduce the value of the asset. The disposal here is 290. So meaning now the balancing figure for this account can either be disposal or acquisition, but now it cannot be disposal again because already there's an asset which we have deducted there, which was disposed, meaning that the balancing figure will be on the debit side, which is an acquisition. They acquired another asset. So they acquired an asset at what value? The balancing figure. At what value? I don't have to do everything from my end. So at least you give me the figures for the balancing figure for
935.
935.
935. 935. That is correct. So when I was doing this account, these three accounts, so I said they are interdependent of each other, and I think you have realized how they depend on each other. So when you are not provided with depreciation, you have to do depreciation account, disposal account, and at the same time PP account. The information to do that will be given. So you have understood how these are done and how they are interdependent. So when I will be doing the investing activities, I will say we acquired an asset and there's money we paid. So cash paid on acquisition of asset. So I will be expecting you give me this figure when I will be doing the investing activities. So for now, let's embark to our statements. So we were under the cash flow before the changes in working capital. Now we mentioned about the changes in working capital. Now we mentioned about the changes in working capital. So the changes in working capital. So I said for the changes in working capital, we consider current assets and current liabilities. So under current assets, according to this question, according to my past paper here, under the current assets, There's inventory. Did the inventory increase or decrease? Is there increase or decrease in inventory?
Increase.
Increase. By which figure?
42.
So increase in inventory. So you have taken 170 minus 128.
128.
Yeah, so that is from 2017 to 2018, 42.
Yes.
So meaning that when your stock increases, what happens to cash? There's money out. You have bought stock, you have paid money. All right. Then for the receivables, debtors, increase, decrease, increase again.
Increase.
So increase in receivable. So for the increase in receivable, the difference is 238 minus 214.
24.
24. So again, you do what? It's money out. Your debtors have increased. You have given them money. So would I consider cash and cash equivalent at this point? You have the knowledge of cash flow. This is not the first time you are doing cash flow in your life. Would I consider cash and cash equivalent at this point?
No.
No, we don't have to consider the cash and cash equivalent. What are we doing? That is even what we are checking. The cash we have at the start, after doing the transaction during the year, the asset tally with the balances at the end. Then for the current liabilities, payables, increase, decrease. Increase in payables. So the increase in payables, that is from 175 to 234. So 234 minus 175. So the difference is, I don't have a calculator, so I expect the answer to come
59.
59. So meaning that
Increase.
increase in payables. So that is when you add increase in liabilities. So it's like a supplier has sold goods to you without you paying. When they decrease, now is when you minus. That is when you have paid your liabilities. So for now, it's just an increase. So up to that point, we say cash generated from operations. Cash generated from operations. So less tax paid. So for tax paid, then once we raise that one, I guess cash flow from operating activities. Give me the figure for cash generated from operations. Cash generated from operations. As I do the working for tax here. So we have to consider if there's current tax and deferred tax, which I can see we have both. Current tax, that is under the non-current liabilities, we have deferred tax, and under current liabilities, we have current tax. So for us to do taxation, the working for tax, we consider both deferred tax and the current tax. So the balance brought down balances brought down for deferred tax and current tax. So the balance brought down for deferred tax is 185. This is for deferred tax. And the balance brought down for the current tax is 94. So you add the two. So these are the balances brought down for both current and deferred. 185 plus 94. Kazi ya kuongeza na kutoa. So 279. I hope that is good. So 279. So then, after the balance is brought down, you consider the tax paid. So the current tax for the year, let me mention that, from the income statement. So the one they were paying for the year, current tax, so the income tax for the year. And let me be more specific, income tax for the year. So this one is from P&L. So from the income statement, from your income statement, there was that tax which they were to pay for that year. Income tax of 80. Yeah? So 279 plus 8 is that is 359. Then you skip one line. Skip one line here. In your exercise book, skip one line. Say balance carry down. Carry down for the deferred taxes, according to my equation here, is 150. That is deferred. Then the balance carry down for the current is 92. Is it 92? So this is deferred tax and this is current tax. 150 plus 92?
42.
But now there's one thing I think I have not mentioned here, which I can see from my question. So before I mention this 359, so there must be deferred tax due to revaluation. So 30% of the revaluation, that is 45. So meaning 359, so 279 plus 80 plus 45. 279, so that is 404. So then minus 242. Minus 242. So the balancing figure now, the reduction is what will be your tax paid.
162.
162. So the reduction is the tax paid. So our tax paid here to be deducted is 162. So what is your figure for the cash generated from operations? 781 minus 42. Kama kuna mwenye alikuwa amefanya niambie anza. Minus 24 plus 59. What is the answer?
633.
No, according to my calculator, I'm getting 774.
Yeah, 774.
772 minus 162. 612. So 612, you can put it on the credit side. So that is your A. At least now we can move very fast. So you have understood this: taxation, balance pro down for deferred tax, current tax, income tax for the year from the income statement, deferred tax due to revaluation, the revaluation which was given in note 1, the 30% of 150, you get the total of 404. That is the tax they were supposed to pay. Then you consider with your balance carry down. So at the end of the year, the tax they are supposed to pay, that is both deferred tax and current tax, is 242. Why did it reduce from 44 to 242? Because they paid 162. Because they paid 162. All right, let's move to investing activities. So did they dispose any asset? Did they dispose an asset? They received any money? There was an asset which was disposed, and that is information was given direct. Cash received on disposal of asset? The note 1, the information we used in the disposal account. So 215, Daniel, that is good. So then there's that working we did. So cash paid on acquisition of asset. So cash paid on acquisition of asset, it was 900 and something, which is the figure?
935.
It was 935. So this one we subtract. Then I said we talk about investment income. Investment income. So here we have other income. So this is the one I will consider for the 21. Then I said that now we consider dividend received. So where can we receive dividends from? Where can we receive dividends from?
From joint venture.
So for us to get the dividend received, so we check under the non-current assets, what is given there. So the investment in an associate or a joint venture. So checking in our question, we have the interest in joint venture. So meaning the dividends they are receiving from joint venture. And that one means that I have to do an analysis, but it's not even a must we do an analysis. What I will do, I will just take that interest in joint venture, the balance brought down, interest in joint venture brought down, plus what they were receiving during the year, what the parent was receiving during the year from that joint venture as income. This one, if you go to your income statement, you will realize that this share of profit of joint venture is added, it's an income. So that is what I will add, the profit they received during the year. So what I get here is what I will compare with the balance carried down of the balance carried down of this interest in joint venture. So the interest in joint venture, the balance brought down is $380 plus 85. You compare with the balance carried down of 427. What's the dividend received? So this is the interest in joint venture, the balance brought down, the balance carried down. The only thing I have added here is all about the share of profit of joint venture, what they were receiving during the year. So meaning that their investment increased from 380 to 380 by 85. 380 plus 85, 465. But their investment at the end is 427. Why did it reduce to 427? They received some dividends of 38. So what do you have here as cash flow from investing activities? What is the answer there? So these are cash outflow of 661. The next thing, the final thing is all about financing activities. Financing activities. So for the financing activities, we check the equity going down. So under equity and liabilities, that is where we concentrate most. What we have not dealt with, what we have not dealt with. So the first item under equity is all about what? The first item under equity is ordinary share capital and the share premium we combine to check what? Issue of shares or redemption of shares. Issue of shares or redemption of shares. Issue of shares or redemption of shares. So the balance brought down is ordinary share capital and share premium. Balance brought down. Ni ngapi na ngapi? I have 1400. So that is 1000 plus the 400. So Daniel, that is good. So then we can add the bonus issue. Stroke rights issue. That is shares issued through bonus issue or rights issue. There was none. But here there was conversion. Conversion of, so that is according to additional information number 2. Conversion of loan stock to ordinary shares. Conversion of loan stock to ordinary shares. How did they do this? So they said in note 2, the 10% convertible loan stock was convertible at any time at the holder's option into 20 ordinary shares of shillings 10 each for every 200 of the loan stock. So 20 ordinary are converted to 200. So this is the proportion, loan stock. So this is the number of ordinary shares, and this is in shillings. So they converted which value? During the year ended 30 September 2018, holders of 180 convertible loan stock exercised their conversion option. So 180 shillings, 180. So we want to determine how many ordinary shares they converted to. So 180 times 20 over 200. So this 180 was converted to how many? It was converted to how many ordinary shares? So this one goes with this. This one is 10. So this and this goes. So that is 18 shares. 18 ordinary shares. So each ordinary shares was going at what value? 10. So if I need to get the value, I multiply by 10. So it remains to be 180 shillings. So they converted to 180 shillings. So the 18 ordinary shares, which we arrived at, are having a value of 180. It has a value of 180. So 1400 plus 180. 1400 plus 180, that is what? 085, 1580. So balance carried down is, so you skip one line there. So balance carried down is, for the ordinary share capital and share premium, 1320 plus 460. So 1320 plus 460, what is the figure? 1320, 1780. That is 1780. So you can see the value increased from 1580 to 1780 to 1780. So meaning that they received cash received on issue of shares due to issue of shares. So how much did they receive? 200. So that is good, Daniel. So they received that is 200. So cash received on issue of shares. Cash received on issue of shares. That is 200. Is there anybody who has a question so far? Because we are almost finishing. We are almost there. Any clarification? So after we have the cash received on issue of shares, so the 200. So the next thing we talk about is now the retained earnings. So under the retained earnings, so I have skipped the revaluation because the revaluation will affect our NCI, the non-controlling interest. That is why we record the revaluation. So for now, let's do the retained earnings. So why do you do the retained earnings? So you carry out the retained earnings workings for you to determine the dividends paid to parents. Dividend paid to parents, not to parent, but by parents. Dividends paid by parents to NCI. So the balance brought down for the retained earnings is $360. So add the profit attributable to parents from the income statement, or we call it holding company on some scenarios. So the profit attributable to parent is the profit attributable to parent from the income statement.
290.
That is 290. So if you take 360 plus 290 is, this is 650. So the balance carried down for the retained earnings. So you skip one line here. The balance carried down, according to my question, 570. Why did their retained earnings reduce from 650 to 570? Is due to the dividends they paid. So they paid a dividend of
80.
So dividend paid by the parent is
808.
8. If you check in that statement of changes in equity, have I not confirmed that 80? Are you seeing that column of the retained profit?
Yes, there is a dividend paid.
There's that dividends paid of 80.
Yes, a reduction, yes.
Yes, that is what I wanted to show you. And the next working is all about NCI. I think you are done with this. So the next thing is all about NCI. So the NCI, the balance brought down, non-controlling interest. The balance brought down non-controlling interest 180. Profit attributable to NCI. NCI is minority shareholders, non-controlling interest, the minority shareholders. The profit attributable to NCI,
25.
that is 25.
Yes.
Then what you do here next is all about add revaluation surplus. So the balance carried down for revaluation is, so the revaluation, the balance carried down as according under equity, 200. Then remember that when we were doing tax, what is that tax? When we were doing this tax paid, the revaluation was 150. We considered 30%, which is 45, which we considered when we were doing this tax. So meaning that the balance 150 minus 45 is 105. So here you add 105. So the balance carried down for the revaluation is 284. So that revaluation surplus is 305 minus 284 is
21.
21.
Yes.
Give me the total. 180 plus 25 plus 21.
226.
That is
226.
226. The balance carried down. So skip one line here. The balance carried down for NCI is 186. So the reduction is the dividend paid.
40.
Dividend paid is 40.
40.
So the dividend paid is 40. So that is fine. So the 40. So dividend paid to NCI. Try to maintain silence. That I mean you mute your mic. We are done. So the last thing is all about interest paid. So if you check in your question, there is a under current liabilities. Because before I talk about current liabilities, remember that for the convertible loan stock, there's nothing to record. Convertible loan stock, there's nothing to record because the balance brought down is 960. Out of this 180 was converted to ordinary shares. So you get what? 780. The same as the balance which is carried down. So there's no change here. You understand that? I think you understand what I've done. And let's talk about dividends paid. So under the current liabilities, you can see interest payable. At the start, they were supposed to pay an interest of 31 plus. During the year, they were supposed to pay an interest of, from the income statement, the finance cost of 85. So the total interest they are supposed to pay is the total of the two. But at the end, you are told the finance cost is the interest payable. They are supposed to pay 100. So meaning they have paid already how much? They have paid
16.
16. Cash flow from financing activities. Give me the total. Remember that this one you deduct. Then you get net cash flow. So what's the total here for the financing?
64.
64. Positive.
Yes.
Yes, 64.
So this is C. So this one was B. For investing, this one was A. So net cash flow will be 612 minus 661 plus 64. What do you have?
15.
15. And cash and cash equivalent brought down. Cash and cash equivalent balance brought down. So the cash and cash equivalent balance brought down is so that you get the cash and cash equivalent. Cash and cash equivalent balance carried down. So the cash and cash equivalent balance brought down. You have it in that current assets. The balance brought down of 63. So this is the balance brought down 2017. So if you add this to 15, you get 78. Can you confirm that this is the one you have as at 2018 in your question as cash and cash equivalent? Is that what you have? That is what you have.
Yes.
That is how
Correct,
you,
yeah.
yes, that is how you are
Yes, correct,
supposed
yeah.
to do. That is how you are supposed to do it. That is how you are supposed to do a cash flow statement. So for marking these questions, it's very easy. I think you have the marking scheme with you. Like now there are sitting question, the cash flow one. All of these entries, there are many. These are a lot. You don't have to be very perfect of getting all of them, but making sure that you get at least half of those entries. Because those entries are more than what? They were it was a 20 marks question, 20 or 18. It was around an 18 marks question. They can need even in that scenario, they can be in need of around 9 correct entries. They can be in need of 9 correct entries. So let me show you that as we close our session today. But obviously, this is the time our class is supposed to end. Ila tu mmezoea ginaisha mapema. That is why nimeona some few students wametoka. But the day was tough. Ayom. The day was tough.
Yes, sir. Yes, sir. The day was tough.
So you have tried to survive. Eh?
Well, we are trying.
So what a simple marking is this? So like now here, remember that this is a 20 marks question. They were in need of how many entries you see? Only 10. Eh? That is why I said when they are not specific, these are a sitting question. The way they have done this is the way I've done my question. So that is why I said when they are not direct, which method to use, go for indirect. Because for the indirect method, from the part of operating itself, that one can give you even more than 10 marks. Anyway, let's meet tomorrow, same time, same place. If there's no question, we continue with the cash flow. We check if we can do that question for our city, this one, and then one more for indirect. That not indirect, for direct. That is maybe a question of 2014 there. That one would be enough, and that would be the end of published. So that next week I introduce group accounting. I think that is okay with you. Have a good night.